Let me tell you about a tax break that most retirees have heard of, but very few actually understand. This is a benefit that your heirs could be counting on without them even knowing it. It's called the step up in basis. And for some families, it's worth hundreds of thousands and maybe even millions of dollars. It's also one of those planning concepts that looks simple on the surface but gets complicated really fast once you start applying it to real portfolios and real estate plans. So today we're going to walk through exactly what the step up in basis is, how it works, where it creates opportunity, and how it saves you money in taxes. This is a short, focused episode. It's only going to be about 10 to 15 minutes. So let's get into it. Hi, everyone. Welcome back to your classroom. I'm Thatcher Taylor, and this is the Functional Retirement Podcast. I'm a certified financial planner. And quick disclosure, nothing is personalized financial or tax advice. Double check your work or my work and how it applies to your particular situation. But everything we're going to talk about is in the tax code. You can read about it yourself. The step up in basis is a real concept that applies accurately in your estate planning models with taxable accounts or certain types of assets. So we got to understand it first. When you buy an investment, a stock, a mutual fund, even a piece of real estate, the cost basis, we need to start here with the cost basis, is simply what you paid for it. That's the starting point that the IRS uses to calculate whether or not there's a taxable gain when the asset is eventually sold. And that's what the step up in basis is when someone passes away, that initial purchase cost, the amount that you paid for it, gets stepped up to the new value as of the date of death. And if you have something that's highly appreciated in value, that step up in basis is really, really important. So the gain is the difference between what you received from the sale and what your basis was when you bought it. So here's a simple example, very simple. Let's say David bought 1,000 shares of a stock 25 years ago for $20 per share. His total basis is 20,000 bucks. Pretty simple. But today those shares are worth $150,000. If David sells them and is still alive, David is still alive and he sells them, his taxable gain is $130,000. That's the difference between the $150,000 sale price and his $20,000 basis. It's usually going to be at a long-term capital gains rate of about 15%. If it is at 15%, which it most likely is, that's a tax bill of $19,500. Now that's how cost basis works in a straightforward sale while someone is living during their lifetime. Now, here's where it gets interesting. Also, if you're liking these podcasts, before we move on, please make sure to like, subscribe, comment, and share this with anybody where you think it's valuable. I don't have a strong social media presence. I don't particularly care for social media at the moment. So this needs to travel by word of mouth. So what the step up in basis actually does when someone passes away and leaves appreciated assets to their heirs, first usually a spouse, then maybe to children, something really remarkable happens under the current US tax law. The heirs don't inherit the original owner's basis. Instead, the basis of the inherited asset is stepped up. It's basically reset to the fair market value of the asset on the date of the owner's death. So let's go back to the David example. $20,000 basis, sells the assets, they're worth $150,000. $130,000 is taxable while he's living if he sold it. When the stock is inherited as of his date of death, it gets a new value, a new basis. Let's say he passed away on a Wednesday and the stock was worth $150,000 on that day. You get to step up to that basis. If she turned around and sold it immediately for $150,000, say on the date of death, or the value a few days later was very close to what it was on the date of death, the taxable gain is zero. Not $130,000 capital gain, it's zero. The $130,000 of appreciation that built up over David's lifetime simply, essentially disappears from a tax perspective. This is in a taxable brokerage account, not an IRA, not a 401k, which we'll get into. This can also apply to houses. But if you want to put a dollar figure on it, most estates that I work with my clients, they're going to be more than $1 million in a taxable brokerage account usually. And there could be appreciation of $500,000 or more. A step up in basis eliminates tens of thousands of dollars in taxes that would have otherwise happened. So the basis, or the step up in basis, is one of the coolest tools for estate planning purposes. You have to understand, when people talk about life insurance, they love the tax-free benefit that passes to their heirs. In a taxable brokerage account with stocks, bonds, ETFs, mutual funds, or high-quality investments, you get the same tax advantages that you would get with really any other asset. Which leads us down the road of when this doesn't apply. But first, I need to be clear. This applies to houses too. This just happened with one of my clients. Mother passed away. They gave the house to their kids, to her two kids, grown children. They were in their 60s or 70s, to be honest with you. They were able to sell the house at the new step-up basis as of the date of death, because the house was essentially paid off. They bought it for very cheap. The mother had owned the house for decades. That was very valuable to be able to get the asset as of the date of death. Next, we need to talk about what doesn't count. I was kind of leading into this, but what doesn't count, or what doesn't receive a step up in basis, are things like IRAs and 401ks. If you have an IRA that has $500,000 in it, there is no basis because you have not paid taxes on that money. Roth IRA as well do not get a step up in basis, although you pay the taxes on them initially. The basis plays a different role in this, but everything that comes out of an IRA is completely tax-free. Roth IRA, is completely tax-free, but pre-tax IRAs and 401ks do not have a step up in basis. Assets gifted before death do not have a step up in basis. This one catches people by surprise more than almost anything else. When someone gifts an appreciated asset during their lifetime, because when you gift something, you lose control of it and it goes to someone else. Rather than leaving it to them at death, the recipient receives the donor's original basis while they're living, not a stepped up basis. That's called carryover basis, and it means the embedded gain doesn't disappear, it transfers. This is where high quality estate planning with a good planner matters, where you can save clients or people thousands of dollars. Is people like to gift things while they're living, which is fine, but you lose the opportunity to get the basis step up as of the date of death. So you really have to understand timing, when things can happen, what should be gifted, what maybe needs to be put on the back burner as a gift so you can get that step up in basis and save money in taxes. So you really got to be careful to navigate this the right way. Another area that does not apply are irrevocable trusts. Now, this is an area where rules get very nuanced and where working with good estate planning attorney matters, because the step up in basis treatment for assets held in trust depends significantly on how the trust is structured. So, for example, assets held in a revocable living trust, which is the most common type of trust used in very basic estate planning. These generally do receive a step up in basis at the grantor or the creator of the trust death. And that's because the revocable trust is treated as part of the grantor's estate for tax purposes. It's basically a trust, or a revocable living trust is very similar to a taxable brokerage account. It's just a trust account, but the tax ramifications are the same. They still apply to the main grantor social security number. But irrevocable trusts are a different story, because irrevocable trusts are usually used to remove assets from the estate during the grantor, which is the creator of the trust's lifetime. This is the whole point from a estate tax perspective, because you're removing the assets out of the estate to protect against current and after death estate taxes, to fall under a specific irrevocable trust rule. Now, there are a variety of different irrevocable trusts, but in general, the step up in basis does not apply. So there's a give and take. Do you want to utilize some estate tax planning now, or do you want to utilize the utilize the estate tax planning benefits by using an irrevocable trust now as the grantor, or do you want to wait till the end to some assets get a step up in basis? But there, there's a whole variety of things that come into play. But no, if you're going to try to use an irrevocable trust to make a more efficient estate, you're not going to get the step up in basis. So that's one downside. And then lastly, another exception that we just need to be aware of is community property states. So community property states are somewhat unique. And this is really important for married couples. It's a variation that we need to mention for listeners in a very certain amount of states. Nine states, basically Western United states. California, Texas, Southwestern, Arizona, Washington, Oregon, Nevada, New Mexico. Is that 9? Anyway, just double check if it's your state. Community property states, married couples who own appreciated assets together may receive a full step up in basis on the entire asset when the first spouse dies, not just the deceased spouse's half, the entire thing. Community property states view all the assets as both the married couples. So let's say you have $1 million and half of it is basis. Half of it is capital gains. So $500,000 of capital gains. In community property states, when the first spouse passes away, the other spouse gets a full step up in basis to $1 million as of the date of death. That's the new basis. In non-community property states, which is most of the country, only the deceased spouse's half of a jointly owned asset, which is usually what happens with a joint taxable account, if you're doing high quality estate planning, only the deceased spouse's half receives a step up in basis. The surviving spouse's half retains its original basis. So instead of getting the full step up, you're only going to get a half step up. So community property and non-community property states are different. So as we talk about this, we're leading into some planning opportunities. The first of which is holding appreciated assets in taxable accounts until death, if you can. This doesn't always apply, but it's not a bad idea if you're utilizing taxable assets for the full step up in basis. If it comes into play, this more or less comes into play with houses. That's where I see it most, because a lot of my clients are using their taxable accounts or trust accounts for income distribution strategies. But you can plan through this and navigate holding appreciated assets until death. The next planning opportunity is a little bit about what we spoke about before, being strategic about what you gift and what you leave. It depends who you're gifting to. If you're gifting to a 501c3 and you have an IRA and you're over the age of 70 and a half, you can do qualified charitable distributions. Maybe you don't gift a lot of appreciated shares. We're saving the appreciated shares till a step up in basis. So you need to be strategic about how you navigate gifts while you're living and what you want to pass to heirs efficiently after you pass away. And a quick word of caution. The step up in basis is a very powerful tax benefit, but it shouldn't be the only consideration in the investment and estate planning decision. It's cool and it's great if it happens and it fits your particular situation, but don't try to force this if it doesn't really provide the benefits that you're looking for. It needs to be meaningful and purposeful as you develop your estate plan. So here's the takeaway. I just think it's really, really cool that the IRS provides this. People get so scared of investing money in a taxable brokerage account because they're looking for other ways to receive current year taxation. Well, the tax benefits may come later. So you really want to have balance with all of your account types, taxable, Roth, and tax deferred. So you need to navigate them all together. You need to utilize this step up in basis efficiently and have a good understanding of it as you move into your estate planning journey. So if today's episode raised any questions about how your appreciated assets are positioned or whether your gifting strategy or your trust structure is preserving or inadvertently forfeiting the step-up in basis, I'd love to have a conversation. I am taking on new clients, very specific clients that need help navigating retirement and managing their assets to support their financial plan. Check down below in the comments. There'll be a link. You can reach out to me directly. I'm a one-stop shop to be able to help navigate tax planning, retirement planning, income distribution strategies, asset management. It's really valuable if you want to utilize me to clean up your retirement planning journey. I hope this episode was useful. Please share it. Send it to someone who's thinking about estate planning or has appreciated investments that they've held for years and they're concerned about it. This might make them feel a little bit better. And please make sure to like, subscribe, and share so we can keep spreading the word for these high quality financial planning tools. Thanks for listening. We'll see you next week.